A ratio is an arithmetical expression of relationship between two related or interdependent items. Ratio analysis is a technique of analyzing the financial statements by computing ratios. Ratio analysis provides a meaningful understanding of the performance and financial position of an enterprise. It helps the management to know the profitability and financial position, which means liquidity and solvency, and the operating efficiency of an enterprise. Current ratio is equal to current assets upon current liabilities, or current assets divided by current liabilities. It is a relationship of current assets to current liabilities. It helps to assess the short-term financial position of the enterprise. Current assets are either in the form of cash or cash equivalents, or can be converted into cash and cash equivalents in the short period of time. Current liabilities are liabilities repayable in short time. Current ratio of 2:1 is considered satisfactory. 2. Liquidity ratio or quick ratio or asset test ratio is equal to liquid assets or quick assets divided by current liabilities. It is a relationship of liquid assets to current liabilities. Quick assets are equal to current assets minus stock plus prepaid expenses. Quick ratio of 1:1 is usually considered favorable. Stock is excluded from liquid assets because it may take some time before it is converted into cash. Prepaid expenses do not provide cash and are excluded from liquid assets.
The first example is XYZ Limited has furnished the following information regarding its current assets and current liabilities. The current assets are cash 5,000, debtors 29,000, bill receivables 5,000, marketable securities 15,000, stock 52,000, prepaid expenses 2,000. The total is 1,08,000. The current liabilities are sundry liabilities at 3 lakhs. The current liabilities are sundry liabilities at 30,000, bills payable at 16,000, outstanding expenses at 8,000. The total is 54,000. We need to calculate the current ratio and liquid ratio and comment on liquidity of the company. The current ratio is given by current assets divided by the current liabilities, which is rupees 10 lakh. The current ratio is given by current assets divided by current liabilities, which is given as 1,08,000 divided by rupees 54,000, which is 2:1. The liquid ratio is liquid assets divided by current liabilities, which is rupees 54,000 divided by 54,000, which is 1:1. Current ratio is 2:1 and liquid ratio is 1:1, which are considered as satisfactory and are ideal ratio. The second example. Current liabilities of a company are rupees 3 lakh. Its current ratio is 3:1 and liquid ratio is 1:1. Calculate the value of stock assuming that the only other current asset is stock. The solution. Current ratio is given by current assets divided by current liability, which is 3 equal to current assets divided by 3 lakh. The current assets is 9 lakh rupees. The liquid ratio, which is 1:1, is given by liquid assets divided by current liability. Therefore, 1 equal to liquid assets divided by 3 lakh. The liquid assets are 3 lakh rupees. Stock is equal to current asset minus liquid assets, which is 9 lakh minus 3 lakh, which is 6 lakh rupees. The third example. From the following, we need to calculate the debt equity ratio. 10,000 equity shares of rupees 10 each will give you 1 lakh rupees. The general reserves are at 45,000, accumulated profits at 30,000, debentures at 75,000. Sundry trade creditors is 40,000, outstanding expenses is 10,000. The solution for this is debt equity ratio is equal to debt divided by equity, which is rupees 75,000 divided by rupees 1,75,000, which is 3:7 or 0.43:1. Equity equal to equity plus general reserves plus accumulated profits, which gives us 1 lakh plus 45,000 plus 30,000, which is 1 lakh 75,000. Example 4. From the following balance sheet of XYZ Limited for the year ended 31st March 2014, we need to calculate the total assets to debt ratio and proprietary ratio. The liabilities are equity share capital at rupees 20,000. The liabilities are equity share capital at rupees 2 lakh, 10% debentures at 1 lakh, bills payable at 10,000, creditors at 40,000. The total is 3 lakh 50,000. The assets on the other hand are cash at bank rupees 20,000, debtors at 30,000, closing stock of 80,000, fixed assets of 22,000. The total assets is 3 lakh 50,000. The solution for this is total assets to debt ratio is total assets divided by long term debt, which is rupees 3 lakh 50,000 divided by rupees 10 lakhs, which is 3.5 is to 1. The proprietary ratio is given by proprietor's fund divided by total assets, which is rupees 20 lakh divided by rupees 3 lakh 50,000, which is 4 is to 7 or 0.571 is to 1. Example 5. The balance sheet of XYZ company is given below. The liabilities are equity share capital, which is 250 lakhs, the general reserve at 280 lakhs, the profit and loss account current year shows 30 lakhs, the secured loans in the long term is 300 lakhs, the secured loan in short term is 360 lakhs, the creditors stand at 150 lakhs and the other liabilities at 30 lakhs. The net liabilities are 1400 lakhs. The assets in lakhs are fixed assets at 400, investment at 50, stock at 460, debtors at 460, cash in hand 10, miscellaneous expenditure not written off is 20. The net assets are 1400 lakhs. The additional information is from the profit and loss account, rupees 90 lakhs were transferred to general reserve during the year. Interest cost amounted to rupees 120 lakhs. Taxation is at 40%. You are required to calculate the debt equity ratio, the current ratio, the interest coverage ratio. The current ratio is given by current assets divided by current liabilities, which is rupees 930 lakhs divided by rupees 540 lakhs, which is 1.73. The debt equity ratio is given by debt divided by equity, which is rupees 300 lakhs divided by 560 lakhs, which is 0.54. The interest coverage ratio is EBIT, which is earnings before interest and tax divided by interest is equal to rupees 320 lakhs divided by rupees 120 lakhs, which gives us 2.66. The working notes for this is EBIT for profit for the year 30 plus 90, which is 120 lakhs. The interest tax at rupees. The working notes for this is earnings before interest and tax, which is profit for the year 30 plus 90, which is 120 lakhs, the interest being 120 lakhs. The tax at 40% of 120 into 40 divided by 60 gives us 80 lakhs, the total of 320 lakhs. Example 6. Opening stock rupees 29,000, closing stock rupees 31,000, sales rupees 3 lakh, gross profit 25% on cost, and calculate opening stock of rupees 29,000, closing stock of rupees 31,000, the sales of rupees 3 lakh, the gross profit is 25% on cost. We have to calculate the inventory turnover ratio. The solution for this is inventory turnover ratio, which is given by cost of goods sold divided by average stock. Let cost of goods sold be X. Gross profit will be 25% of X, that is X by 4. Cost of goods sold plus gross profit equal to sales, which is X plus X divided by 4 is equal to 3 lakh. In that case, X equal to 2 lakh 40,000. Average stock is equal to opening stock plus closing stock divided by 2, which is rupees 29,000 plus rupees 31,000 divided by 2, which is 60,000 divided by 2, which gives us 30,000. The inventory turnover ratio in this case is now rupees 24. The inventory turnover ratio in this case is now rupees 2,40,000 divided by 30,000, which is 8 or 8 times. From the following detail, calculate example 7. From the following detail, example 7. From the following detail, calculate the debtors turnover ratio. Total sales of the year is rupees 1,75,000. Cash sales is 20% of total sales. Sales return out of credit sales is rupees 10,000. Sundry debtors opening balance is rupees 8,000 and the closing balance is rupees 12,000. We need to calculate the debt turnover ratio. It can be calculated as debt turnover ratio is given by net credit sales divided by average debtors. Net credit sales equal to total sales minus cash sales minus sales return, which is rupees 1,75,000 minus rupees 35,000, which is 25. Net credit sales is total sales minus cash sales minus sales return, which is rupees 1,75,000 minus 35,000 minus rupees 10,000, which is rupees 1,30,000. Average debtor is equal to opening debtor plus closing debtors divided by 2, which is rupees 8,000 plus 12,000 divided by 2, which is rupees 10,000. Debtor turnover ratio is rupees 1,30,000 divided by 1000, which is 13 or 13 times. Example 8. Opening sundry creditors rupees 80,000. Opening payable rupees 3,000. Closing sundry creditors rupees 1 lakh. Closing bills payable rupees 17,000. The purchases at rupees 14 lakh. Cash purchases rupees 14 lakh. Cash purchases rupees 5 lakh. Purchase returns rupees 1 lakh. We need to calculate the creditors turnover ratio. Creditors turnover ratio is net credit purchases divided by average creditors, which is net creditor purchase. The solution for this is creditor turnover ratio, which is given by net creditor purchase. The solution for this is creditors turnover ratio, which is given by net credit purchases divided by average creditors. Net credit purchases is given by purchases minus cash purchases minus purchase returns, which is rupees 14 lakh minus rupees 5 lakh minus rupees 1 lakh, which is rupees 8 lakhs. Average creditors is opening creditors. Average creditors is equal to opening creditors plus bills payable plus closing creditors plus bills payable divided by 2, which is rupees 80,000 plus rupees 10, which is rupees 80,000 plus rupees 3,000 plus rupees 1 lakh plus rupees 17,000 divided by 2, which is rupees 1 lakh. Creditors turnover ratio is now 8 lakh divided by 1 lakh, which is 8 or 8 times. The following is the balance sheet of XYZ Limited as on 31st March 2014. The liabilities are share capital at 80,000, general reserve at 30,000, profit and loss account at 50,000, mortgage loan at 10% at 80,000, creditors at 40,000 and bills payable at 20,000. The net liabilities are 3 lakh rupees. The assets on the other hand are fixed assets at 1,60,000, debtors at 60,000, bill receivable at 20,000, cash at bank at 50,000, preliminary expenses at 10,000. The net assets are 3 lakh. The other informations are sales during the year 2013-14 amounted to rupees 1,60,000. We need to calculate the fixed asset turnover ratio, the current asset turnover ratio, the working capital turnover ratio. The solution for this is fixed asset turnover ratio is equal to sales divided by fixed assets, which is rupees 1,60,000 divided by rupees 1,60,000, which is equal to 1 or 1 times. Current asset turnover ratio is equal to sales divided by current assets, which is given by rupees 1,60,000 divided by rupees 1,30,000, which is 1.23 or 1.23 times. Current assets equal to debtors plus bill receivable plus cash at bank, which is rupees 60,000 plus rupees 20,000 plus rupees 50,000, which is 1,30,000. The working capital ratio is given by sales divided by working capital, which is rupees 1,60,000 divided by rupees 70,000, which is 2.28 or 2.28 times. The working capital is given by current assets minus current liabilities, which is rupees 1,30,000 minus rupees 60,000 is equal to rupees 70,000. Compute the gross profit ratio based on the following information. Sales rupees 6 lakh, gross profit 25% on cost. The answer for this is let the cost be rupees 100, gross profit is rupees 25. The sales is rupees 125. Cost of goods sold is equal to 100 divided by 125 into 6 lakhs, which is 4,80,000. Gross profit equal to sales minus cost of goods sold, which is rupees 6 lakh minus rupees 4,80,000. This gives us rupees 1,20,000. Gross profit Gross profit ratio is gross profit divided by net sales into 100 is equal to rupees 1,20,000 divided by rupees 6 lakh, which is 20%. Example 11. From the following details, calculate operating ratio. Cost of goods sold is rupees 6 lakh, operating expenses is 40,000, sales is 8 lakh 20,000 rupees, and sales return is rupees 20,000. The solution for this is operating ratio is equal to cost of goods sold plus operating expenses divided by net sales into 100. Rupees 6 lakh plus rupees 40,000 divided by 8 lakh into 100, which is 80%. Example 12. Gross profit ratio of a company was 25%. Its cash sales were rupees 20 lakh and its credit sales were 90% of the total sales. If the indirect expenses of the company were rupees 20,000, calculate its net profit. The solution for this is total sales equal to cash sales plus credit sales. Cash sales equal to 2 lakh. The credit sales is 90% of total sales. The total sales equal to cash sales into 100 divided by 10, which is rupees 2 lakh, into 100 divided by 10, which is 20 lakhs. Gross profit equal to rupees 20 lakh into 25%, which is 25 by 100, equal to 5 lakh. Net profit equal to gross profit minus indirect expenses, which is rupees 5 lakh minus 20,000, which is rupees 4 lakh 80,000. Net profit ratio is ratio. Net profit ratio is net ratio divided by net sales equal to rupees 4 lakh 80,000 divided by rupees 20 lakhs into 100, which is 24%. Example 13. Following is the balance sheet of XYZ Limited. Example 13. Following is the balance sheet of X Limited as on 31st March 2014. The liabilities are as follows. The share capital of 20 lakh, the reserve at 5 lakh, the 10% loans at 10 lakh, current liabilities at 15 lakh, and profit for the year at 5 lakh. The net liabilities are 55 lakhs. The assets on the other hand are fixed assets net at 29 lakhs, current assets at 25 lakhs, and underwriting commission at 10 lakh. The net assets are 55 lakhs. We need to find out the return on capital employed. Solution. Profit before interest is profit as stated, which is 5 lakh. Addition. The solution for this is profit before interest, which is profit as stated, at rupees 5 lakhs. We need to add interest, which is 10% of rupees 10 lakh, which is 1 lakh. The total is 6 lakhs. Capital employed in fixed assets is rupees 29 lakhs. Additional working capital, which is rupees 25 lakhs minus rupees 15 lakhs, which is rupees 10 lakhs. The total is rupees 39 lakhs. Return on capital employed equal to profit before interest divided by capital employed into 100, which is rupees 6 lakhs divided by rupees 39 lakhs into 100, which is 15.38%. Example 14. Net profit after interest and tax is rupees 11 lakh 10,000. The profit distributed as dividend per share is 50%. Equity share capital of 10,000 shares at rupees 100 per share, which is rupees 10 lakhs. We need to calculate the dividend per share. The dividend per share or DPS is given by profit distributed as equity divided by the number of equity shares, which is rupees 5,55,000 divided by rupees 10,000, which is rupees 55.5. The example 15. The capital of Everest Company Limited is as follows. 9% preference share of rupees 10 each, which is at 30 30,000 rupees, which is at 3 lakh rupees. Equity share of rupees 10 each at 8 lakh rupees. Example 15. The capital of Everest Company is as follows. 9% preference share of rupees 10 at 3 lakh, equity share of rupees 10 each at 8 lakh, which is the total is 11 lakhs. The accountant has ascertained the following information. Profit after tax at 60% per annum is 2,70,000. Equity dividend paid to at 20 Equity dividend paid at 20% is 60,000. market price per equity share is 40, we are required to calculate the following. Earnings per share, price earnings ratio. Earnings per share is given by net profit after preference dividend divided by number of equity share, which is rupees 20, which is rupees 2,70,000 minus rupees 27,000 divided by rupees 80,000, which is rupees 3.0375. Price earning ratio is given by market price per share divided by earning per share, which is rupees 40 divided by rupees 3.0375, which is 13.16.